Snowflake, symbol SNOW on the New York Stock Exchange, trades around $182. Market cap is around 58, 59 billion. So the stock jumped 20% last week on the back of revenue growth that bested expectations. For context, it's important to point out here that even after this snapback, Snowflake shares are down 45% year to date and 54% from their 2021 highs. So what does Snowflake do? They enable data storage and processing of analytic solutions that are faster, easier to use, and far more flexible than traditional offerings out in the market. The company's platform offers Data Cloud, which enables customers to consolidate data into a single source of truth to drive meaningful business insights, building data-driven applications, and sharing data. Its platform is used by various organizations of sizes and range of industries. So what we saw after these numbers, the revenue growth was tremendous there that we saw. And I'll give them that. But in the wake of these, there was headlines out there that I see from some of these quasi-analysts. And I'll read one of the headlines here. It says, Snowflake smashes earnings with blistering growth. Well, except then you drop down to the actual earnings line or net income, you see that the company is still losing gobs of money. Yeah, I know that they are using earnings as a catch-all for the earnings or this press release, but earnings to me and net income are different from revenues, and they kind of seem to conflate these two together. It's been glossed over by many analysts to the point that you look at no net income, you justify that by saying huge investments in R&D for future growth. That is it's a good theory, and I understand that argument. But if I had a dime for every time I've heard this, or every time I hear the company is going to be the next Amazon, I'd be doing these videos. I wouldn't even be doing these videos, is what I'm trying to say. Which, of course, I love doing these videos. My point is that even a stock or business with tremendous revenue growth, and again, Snowflake's case, it's staggeringly good growth. If it has negative earnings and is just breaking into cash flow, but it trades at over, say, 33 times, this is what Snowflake trades at, 33 times enterprise value to sales. It's one of the only traditional multiples we can use to put a number on the stock. That's a really high multiple. So it's not surprising for me to see the stock. If you look at a 6-month chart on it, it shows declines. If you look at a 1-year chart on this company, it shows declines. Since its IPO, it shows declines. This is despite the fact that consistently Wall Street analysts basically wet themselves with enthusiasm over this stock. I mean, if you look at it right now, at present, the current consensus among 37 analysts covering the stock, 21 rank it as a buy, 4 as an outperform, 10 as a hold. So 95% suggest you own the stock. 0 rank it as underperform, but there's 2 sells on the stock, which is actually shocking. To even see 1 sell here. And throughout all the declines that we've seen, there was basically between 1 and 0 analysts ranking it as a sell. So what I'll call these quasi-analysts, these fanboys or analyst bloggers, I'm not sure what else to call them, but the curious part of the pandemic is the growth the growth in this area started before the pandemic. It kind of reached a fevered pitch in the pandemic. They kind of show undying support for businesses, largely ignoring the underlying fundamentals, no matter what the story those underlying fundamentals are telling. I'm going to quote directly from this report. One of the reports I'll use an example is this in a second. So many of these, analysts have been absolutely punished in these markets, beaten up worse than Brennan is on a weekly basis on this podcast, or Kathy Wood's returns look year to date. It just doesn't seem to be sinking in, is what I'd say. In this report, this analyst went through all the numbers, did the cash flow analysis, saw the stock was still 30 to 50% overvalued based on the model, and yet still placed a buy rating on the stock. So the direct quote is, the only issue for me has to be the valuation of Snowflake, which has come down substantially, but is still slightly above my intrinsic fair value estimate. However, I will label the stock as a buy due to the business's quality and its cheap valuation relative to history. So this historical cheap number comes from the fact that it now trades at 33 times sales versus the insane multiple of 9.8 achieved in its really only full public year as a traded stock. Snowflake went public in late 2020, so 1 to 2 years of full historical data is not enough to start making historical comparisons, particularly when that year is 2021, which is surely an outlier as a historical norm, as broad valuations in tech were historically high. Now, the biggest point here for me is that everything must go so well for Snowflake over the next 2 to 5 years for the stock to justify its current market value, its market cap of $59 billion. That if anything derails the growth or the margins improving story, there is just zero margin of safety. Investors should not be creating a 15 to 25 core stock portfolio with a company of that profile. Love the growth, but valuations matter. Forget that at your peril. Snowflake seems like a strong growth company. It is breaking into solid cash flow, which we like to see, but the valuation profile has too much risk if that's the type of profile of a company you want to stick with in your portfolio overall.